What's better, a dividend stock portfolio or income annuities? Financial advice often focuses on building up assets and maximizing the return on your investment during your accumulation years. But just as important is the distribution phase, where you spend that money and turn it on in the form of income. Retirees that we work with, they want income streams to be a smooth ride, and more importantly, won't run out of money during their lifetime. In this video, we're going to compare two different options, a dividend stock portfolio and income annuities. We're here to teach you ways to reach, achieve, and maintain financial independence with your money. We all want to optimize retirement income. Dividend stock portfolios and income annuities are two popular ways to create income in retirement. Comparing the two involves considering their respective advantages and disadvantages. So let's first talk about dividend stock portfolios. Dividend stocks are shares of companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. Now, dividends are typically paid on a quarterly basis, although some companies they may pay them annually or semi-annually. The different types of dividend stocks include blue chip stocks. These are shares of large, well-established companies with a history of stable earnings and dividend payments. Some examples of these big, large companies include Coca-Cola, Johnson & Johnson, and Procter & Gamble. There's also the dividend aristocrats. These are companies that have consistently increased their dividends for at least 25 consecutive years. Now, these companies are often seen as reliable and financially sound. And then there are high yield stock companies. These companies offer higher than average dividend yields. And while they can provide significant income, they also carry higher risks. Historically, dividend stock portfolios yield between 3 to 5%. What are the pros of dividend portfolios? They include number one, the potential for growth. Dividend portfolios offer the potential for capital appreciation along with regular dividend payments, providing a source of income while allowing your investment to grow over time. It also provides flexibility. Dividend portfolios offer greater flexibility compared to annuities, allowing you to adjust your investment strategy, reallocate assets, or access funds as needed. The third is it can also provide an inflation hedge. Dividend paying stocks may offer a degree of inflation protection because these dividends can increase over time, potentially keeping pace with or even exceeding the rate of inflation. And then fourth, there's also this ownership of assets. What I mean by that is with the dividend portfolio, you maintain ownership of the underlying assets, giving you the opportunity to benefit from potential capital gains in addition to dividend income. What are some of the cons of a dividend portfolio? The first is market risk. Dividend portfolios are subject to market fluctuations and volatility, meaning that the value of your investments can fluctuate over time. And this could lead to capital losses, especially during market downturns. It also has income volatility. Dividend payments are not guaranteed and they may fluctuate based on company performance, economic conditions, or management decisions, leading to variability of income. It also requires management. When creating a dividend portfolio, managing that portfolio requires ongoing monitoring, research, and decision making to select appropriate investments, rebalance the portfolio, and adjust it to changing market conditions. There's also tax considerations. Dividend income may be subject to taxes, which can impact the overall returns, especially for high income investors. And then finally, you may require more assets out of your retirement portfolio to recreate your income goal. For example, if you want to generate $50,000 a year and your dividend portfolio yields 4%, you're going to need to carve out $1.25 million from your retirement savings to generate that income stream. Let's talk about income annuities. Income annuities are financial products designed to provide a steady, reliable stream of income, typically for the remainder of an individual's life or for a specified period. These annuities are particularly useful for retirees who are seeking a predictable income source. Now, what are the types of income annuities? One type is called a single premium immediate annuity, called SPIAs. You make a one-time lump sum payment in exchange for immediate income payments today. The second is deferred income annuities. Here you make a lump sum payment or a series of payments and begin receiving income at a future date. This allows for a higher payout rate since the income starts a lot later. Here's some key features, benefits, and considerations related to income annuities. Some of the pros around income annuities include number one, it may require less assets to recreate your income goals. Recall the dividend stock portfolio, and that needed 1.25 million to create $50,000 in income, assuming a 4% yield. Depending on the type of annuities utilized, to generate the same $50,000, you may need only about $900,000. This allows the remaining $350,000 to be allocated in maybe a more aggressive asset allocation model that's focused on growth for the next 10, 15, maybe even 20 years. Now imagine what the value of that portfolio could be over that time frame. Second, predictable income. Income annuities provide a steady stream of income for a specified period of time or even for life, offering predictability and stability in retirement. It also protects against longevity risk. Annuities protect against the risk of outliving your savings by providing income for as long as you live, reducing the fear of running out of money in retirement. Fourth, it's the simplicity. Annuities can simplify retirement planning by providing a straightforward solution for generating income without the need for ongoing management or monitoring. And then some insurance benefits include death benefits that ensure a minimum payout to beneficiaries that can provide financial protection for loved ones. Now, what are some of the cons or disadvantages? One is the lack of flexibility. Annuities typically lack flexibility because these funds are committed to the annuity contract, limiting access to the money and potentially restricting your ability to respond to changing financial needs or even emergencies. Second is the cost and the fees. Annuities often come with fees and expenses, including administrative fees, mortality and expense charges, surrender charges if you withdraw funds early. All this can reduce the overall returns of your portfolio. The third is inflation risk. Fixed annuities may not provide inflation protection, meaning that the purchasing power of your income may decrease over time if it's not adjusted for inflation. Fourth is counterparty risk. Annuities are only as strong as the insurance companies that issue them. If the insurer experiences financial difficulties or they go bankrupt, there's a risk that you may not receive the full value of your annuity payments. In summary, income annuities offer predictability and protection against longevity risk, but lack flexibility and may involve fees. Dividend portfolios offer growth potential, flexibility, and inflation protection, but comes with market risk and requires ongoing management. Now, the choice between the two, it depends on your individual preference, your risk tolerance, your financial goals, and your retirement needs. I hope you found this video helpful. When it comes to income, it is challenging, but we're here to help. Thanks for watching.